what are you telling clients about this tariff war right now?
So increasingly, I think every country, including the U.S., thinks that the tariff is it's a lose-lose for everyone. And so what we are saying to our clients is maintain a highly diversified portfolio across asset classes. So if you look at how we've been managing discretionary portfolios, for example, we've been highly overweight in alternatives, primarily gold, and that has gone up like 20% year to date. So that has kind of dampened.
Does gold have more to go, do you think? I mean, at these levels above 3,200?
Yeah, we think so. I think there is a very interesting development that's taking place in the gold market. Holders of futures contracts, derivatives are now demanding delivery of physical gold. And I think we will reach a point in time where everyone kind of look at each other and say, we do not have enough gold bars.
And then what happens?
There will be a short squeeze, and I think this gold price can kind of leap higher as this realization come into play. So in the portfolio of alternatives, gold, which is 7-8% of our portfolio, investment grade bonds, and growth equities, we are down like 3 to 4%.
Gold is 7 to 8% of your portfolio.
That's
right
right.
now?
Yeah,
Wow.
gold and some gold mining shares. Yeah.
Okay, all right. Miners, why miners though? They've been lagging.
Yeah, so it's the same story, right? If everyone kind of look at each other and say, there's not enough physical gold, then what's next? Let's buy gold in the ground. That's the play.
Okay, Sherry, come in on this.
Yeah, and talk to us about your exposure to private assets along with gold that you have. And you're calling for 30% alternatives. How would that 30% be constructed at this point?
So we would have private equity, we would also have private credit. The interesting thing about private assets these days is there's what we call a semi-liquid version of private assets, so there is some liquidity. But really, the private asset strategy generate more alpha returns than beta, i.e. non-market directional returns, and therefore it is a very, I would say, good source of uncorrelated returns to the entire portfolio. So we do, therefore, buy into private assets, private equity, private credit, and hedge funds. Now, I was talking about alpha returns, and therefore, not every, GP or fund manager in these asset class could generate alpha returns. So the selection of managers is of utmost importance here.
I do want to get into the hedge fund angle, which is really fascinating. But just staying with the private and the private credit, is it simply the fact that the market doesn't have to mark to markets for now? So the idea would be just ride out this volatility, but should be okay in 3 to 5 years from now?
Yeah, there is an element that it is, unlike public markets, they are not kind of mark to market that regularly. But if you kind of look at the returns generated from this asset class of private markets, really a lot of the return is from alpha. So they actually add value. The GPs go into a company that they are invested in. They try to add value through operating efficiency, scaling up. So if you look at the the long-term returns, even though the beta of the market is negative, you find that private asset returns can be positive. So really, the alpha returns are a very powerful, non-correlated source of return for our portfolios.
And you're saying hedge funds are making a comeback. Is it just simply being able to have that long-short management in this kind of uncertain environment?
Yeah, so long-short is one strategy. Then we've got macro, we've got CTAs, relative value. What is good about hedge funds, again, is the source of returns is alpha. So again, manager selection is of utmost importance. So for example, in a pool of 10 hedge fund managers, probably only 2 generates you very good returns, the rest do not. So again, we have to pay a lot of attention on the track record and the capabilities of these hedge fund managers.
Wey Fook, people have been talking about sort of a sell U.S. trade. Anything which is dollar denominated is probably not where you want to be. Yet you are still overweight U.S. technology. Why?
Yeah, if you look at the trajectory of earnings, it remains very strong. So there is a secular, growth in earnings for technology companies. Why? Because the world is transforming into a digital economy. Innovations upon innovations over the years. Today it's AI. And therefore, we think there will be obviously some cyclical bumps, down markets for a short period of time, which probably will happen in the next 1-2 years. But really, there is a big long-term.
Isn't that what we've been seeing with the Mag 7 already?
Yeah. So what is very interesting now is the valuations have become very attractive. They are down 30%. We continue to like it for the long-term secular story.
Why not China AI names?
So China, we like China for domestic consumption play. So China, we like the large banks. We also like internet platform companies. So if you look at the big, equivalent of Mag 7 in China, a lot of their source of growth comes from the domestic economy, and not so much exposed to these tariffs. So in China, we like that particular play.
You're expecting more stimulus, domestic stimulus?
I mean, the Chinese government has a lot of leverage. Their debt to GDP 25%, as compared to 120% debt to GDP in US. So they have a lot of levers to stimulate the economy.